Welcome back, everyone, to our lecture series. Today, we are diving into Chapter 2 of our syllabus, Qualitative Characteristics of Useful Financial Information. In this lecture, we will cover the following topics: Introduction to Qualitative Characteristics, Fundamental Qualitative Characteristics, Relevance, Materiality, Faithful Representation, Applying the Fundamental Qualitative Characteristics, Enhancing Qualitative Characteristics, Comparability, Verifiability, Timeliness, Understandability. Applying the enhancing qualitative characteristics. The cost constraint on useful financial reporting. Introduction to Chapter 2. The qualitative characteristics of useful financial information are essential for identifying the types of information that are most beneficial to investors, lenders, and other creditors. These characteristics ensure that the financial information provided is of high quality and aids in decision-making. Financial reports offer information about an entity's economic resources, claims against the entity, and the effects of transactions and events that alter those resources and claims. This is referred to as information about economic phenomena. Additionally, some financial reports include forward-looking information, such as management's expectations and strategies for the entity. These qualitative characteristics apply not only to financial statements, but also to other forms of financial information provided by the entity. The cost of providing this information is a pervasive constraint that entities must consider, balancing the benefits of the information against its cost. Information about economic phenomena. Scenario: a company's balance sheet shows a significant increase in accounts receivable. Example: this information helps users understand that the company has made more sales on credit, indicating potential future cash inflows. However, it also raises questions about the company's credit risk and how well it manages its receivables. Explanatory material and forward-looking information. Scenario: a company's financial report includes a section where management discusses future strategies and market expectations. Example: if a tech company's management discusses plans to invest in new AI technology, this forward-looking information helps investors assess the potential for future growth and profitability. However, the reliability of this information depends on the accuracy and honesty of management's expectations. Conclusion: understanding the qualitative characteristics of useful financial information is crucial for making informed decisions based on financial reports. These characteristics ensure that the information provided is relevant, faithfully represented, and useful for decision-making, while also considering the cost of providing this information. Qualitative characteristics of useful financial information. We will break down each title separately, ensuring that you understand these concepts thoroughly with detailed examples. Qualitative characteristics of useful financial information. Explanation. For financial information to be useful, it must be relevant and faithfully represent what it purports to represent. Additionally, the usefulness of financial information is enhanced if it is comparable, verifiable, timely, and understandable. These characteristics ensure that the information provided in financial reports is of high quality and can effectively assist users in making informed decisions. Fundamental qualitative characteristics. The fundamental qualitative characteristics are relevance and faithful representation. Let's break these down. Relevance. Explanation. Relevant financial information is capable of making a difference in the decisions made by users. Information can be relevant even if some users choose not to take advantage of it or are already aware of it from other sources. Financial information is relevant if it has predictive value, confirmatory value, or both. Predictive value. Information has predictive value if it can be used to predict future outcomes. This means that users can rely on this information to form expectations about the future performance or condition of the entity. Confirmatory value. Information has confirmatory value if it provides feedback about previous evaluations. This means that users can compare the information with past predictions or expectations to see if they were accurate. Example: predictive value. A company's historical revenue data can help investors predict future revenue trends. For instance, if a company has shown consistent revenue growth over the past 5 years, investors might predict continued growth. Let's say company ABC had revenues of $1 million, $1.2 million, $1.5 million, and $1.8 million in the past 4 years. Investors might use this trend to predict that next year's revenue could be around $2 million. Confirmatory value. If a company predicted its annual revenue to be $1 million and the actual revenue matches this prediction, the actual revenue data confirms the accuracy of the company's forecasting process. For example, company XYZ forecasted a revenue of $5 million for the current year, and the actual revenue came out to be $5 million, confirming that the forecasting methods used were reliable. Materiality. Explanation. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions of users. Materiality is specific to the entity and depends on the nature or magnitude of the items related to the financial report. The board cannot set a universal threshold for materiality because it varies depending on the context and the entity. Example. If a small local bakery has $1,000 in petty cash, this amount is immaterial to a decision-making process. However, if the bakery has $1 million in cash reserves, this information is material because it significantly impacts the bakery's liquidity assessment. For a large corporation like Apple, a $1 million transaction might be immaterial, but for a small business, it could be very significant. Therefore, materiality is relative and entity-specific. Faithful representation. To be useful, financial information must faithfully represent the economic phenomena it purports to represent. Faithful representation means the information is complete, neutral, and free from error. Complete. All necessary information is included for a user to understand the phenomena. This means providing a full picture without leaving out any important details. Neutral. The information is unbiased and not manipulated. It should be presented in a way that is fair and objective, without favoring any particular outcome. Free from error. There are no errors in the description or the process used to produce the information. This does not mean perfection, but rather that the information is reliable and accurate as far as can be reasonably expected. Example. Complete. If a company reports its assets, it should provide a full description, including the type of assets, their value, and how the value was determined. For example, if company ABC has a group of assets worth $10 million, it should specify what those assets are, e.g. buildings, machinery, vehicles, how they were valued, e.g. historical cost, fair value, and any other relevant information. Neutral. When reporting financial performance, a company should present all gains and losses without exaggeration or understatement. For instance, if a company incurred a loss due to a market downturn, it should report the loss honestly without trying to make it look smaller than it is. Free from error. If a company estimates the value of an asset, it should clearly state that it is an estimate and explain the method used to derive the estimate. For example, if company XYZ estimates that its inventory is worth $500,000, it should explain that this is based on the lower of cost and net realizable value method and describe how the estimate was calculated. Applying the fundamental qualitative characteristics. Explanation. For information to be useful, it must be both relevant and faithfully represented. This involves identifying an economic phenomenon, determining the most relevant information, and ensuring it provides a faithful representation. Sometimes a trade-off is necessary between relevance and faithful representation. Example. Suppose a company is estimating future cash flows from a new project. This estimate is highly relevant for investors to decide whether to invest in the company. However, there is a high level of uncertainty due to market volatility. The company should provide this estimate along with an explanation of the uncertainties involved. If the estimate is too uncertain, a less relevant but more reliably measured piece of information might be more useful. For example, If predicting future cash flows is highly uncertain, the company might instead provide historical cash flow data along with a discussion of how current market conditions might affect future cash flows. Summary. In this section, we have explored the fundamental qualitative characteristics of useful financial information: relevance, materiality, and faithful representation. These characteristics ensure that the financial information provided is useful for decision-making by being capable of making a difference, reflecting the true economic phenomena, and being complete, neutral, and free from error. Enhancing qualitative characteristics. In addition to the fundamental qualitative characteristics of relevance and faithful representation, there are several enhancing qualitative characteristics that further improve the usefulness of financial information. These are comparability, verifiability, timeliness, and understandability. Each of these characteristics plays a vital role in ensuring that financial information is as useful as possible for decision-making. Comparability. Explanation. Comparability enables users to identify and understand similarities and differences between items. This characteristic is crucial for users who need to make decisions based on comparisons, such as choosing between investing in different entities or assessing the performance of an entity over different periods. Consistency versus comparability. Consistency refers to using the same accounting methods over time or across entities. While consistency aids comparability, comparability itself requires that like items look alike and different items look different. Consistency helps achieve comparability, but it is not the same. Comparability is the broader goal that consistency helps to realize. Uniformity versus comparability. Uniformity means making unlike things look alike, which does not enhance comparability. Comparability requires truthful representations where similar items are shown similarly and dissimilar items are shown differently. Example: financial statements comparison. If Company A and Company B are in the same industry, their financial statements should use similar accounting principles to allow investors to compare their performance accurately. For instance, both companies might use the same method of depreciation for their machinery, straight line method. This allows an investor to compare their respective asset values and expenses. If Company A uses straight line depreciation and Company B uses an accelerated method, the comparison of asset values and expenses might be distorted. However, if disclosures are provided that explain the differences in methods, users can make adjustments to compare the companies more accurately. Verifiability. Explanation. Verifiability means that different knowledgeable and independent observers can reach a consensus that a particular depiction is a faithful representation. This characteristic ensures that financial information is reliable and can be trusted by users. Direct verification. Direct verification involves verifying information through direct observation. For example, counting cash to verify the cash balance reported. Indirect verification. Indirect verification involves verifying inputs and recalculating outputs using the same methodology. For instance, checking the inputs to an inventory valuation model and recalculating the ending inventory using the same cost flow assumption, e.g., FIFO, first in, first out. Example: direct verification. An auditor physically counts the cash in the company's safe to confirm the cash balance reported on the balance sheet. Indirect verification. To verify the inventory balance, an auditor checks the quantities and costs recorded in the company's system and then recalculates the inventory value using the FIFO method. If the reported inventory value matches the recalculated amount, the information is considered verifiable. Timeliness. Explanation. Timeliness means that information is available to decision makers in time to influence their decisions. Information loses its relevance if it is not available when needed. Therefore, providing information promptly is crucial for its usefulness. Timeliness versus usefulness. Generally, the older the information, the less useful it becomes. However, some information remains relevant over longer periods because it helps users identify and assess trends. Example: quarterly earnings reports. Companies typically release quarterly earnings reports shortly after the end of each quarter. These reports provide timely information about the company's financial performance, enabling investors to make informed decisions about buying, selling, or holding the company's stock. If these reports were delayed by several months, the information would be less useful for making timely investment decisions. Understandability. Explanation. Understandability means presenting information clearly and concisely so that users can comprehend it. Financial information should be classified, characterized, and presented in a way that is easy to understand for users who have a reasonable knowledge of business and economic activities. Complexity versus understandability. Some financial phenomena are inherently complex and cannot be simplified without losing essential information. While it's important to present information clearly, it is also necessary to ensure that reports are complete and not misleading. Example: clear presentation. A company's annual report includes a section that explains its financial statements and notes in plain language, avoiding technical jargon. For instance, instead of using complex financial terms, the company might explain that accounts receivable are amounts owed to the company by its customers. This makes the information more accessible to users who may not have extensive accounting knowledge. Applying the enhancing qualitative characteristics. Explanation. The enhancing qualitative characteristics should be maximized to improve the usefulness of financial information. However, they cannot make irrelevant information useful or information that does not faithfully represent what it purports to represent. Applying these characteristics is an iterative process and sometimes involves trade-offs. Iterative process. Enhancing qualitative characteristics do not follow a specific order and may require balancing. For instance, a new accounting standard might initially reduce comparability, but improve relevance and faithful representation in the long term. Trade-offs. Enhancing one characteristic might sometimes mean reducing another. Appropriate disclosures can help mitigate any negative impacts. Example: new accounting standard. A new accounting standard requiring a more detailed method of revenue recognition might initially reduce comparability with past periods or other companies that haven't yet adopted the standard. However, this new method might provide more relevant and faithfully represented information. Disclosures explaining the change and its impact can help users understand and adjust their comparisons. Conclusion. In this section, we have explored the enhancing qualitative characteristics of useful financial information: comparability, verifiability, timeliness, and understandability. These characteristics ensure that financial information is as useful as possible, aiding users in making well-informed decisions. The cost constraint on useful financial reporting. Explanation. The cost constraint on useful financial reporting acknowledges that while providing financial information is beneficial, it also incurs costs. These costs must be justified by the benefits derived from the information. The goal is to ensure that the value of the information provided outweighs the costs involved in its production and use. Here's a detailed look at the various aspects of this constraint. Types of costs and benefits. 1. Costs to providers of financial information. Collection and processing. Gathering and processing data to prepare financial statements. Verification. Costs incurred for auditing and verifying the information to ensure its accuracy. Dissemination. Costs related to distributing the financial information, such as printing reports or maintaining digital platforms. 2. Costs to users of financial information. Analysis and interpretation. Users, such as investors and analysts, spend time and resources to analyze and interpret the information provided. Additional information. If financial reports do not include all necessary information, users may incur extra costs to obtain this information from other sources or make estimates. 3. Benefits of financial reporting. Improved decision-making. Relevant and faithfully represented financial information helps users make better investment, lending, and other financial decisions. Efficient capital markets. Better information leads to more efficient markets, reducing the cost of capital. Informed decisions. Individual users, including investors and creditors, benefit from making more informed decisions, potentially leading to better returns or lower risks. Example: implementation of a new standard. Costs. A company might incur significant costs in implementing a new accounting standard that requires detailed disclosures about lease obligations. These costs could include system upgrades, additional staff training, and more comprehensive audits. Benefits. The detailed information helps investors better understand the company's financial position and future cash flow obligations, leading to more informed investment decisions and potentially a lower cost of capital for the company. Assessing costs versus benefits. When the board, such as the IASB, develops new accounting standards, it evaluates whether the benefits of the proposed information justify the associated costs. This assessment involves gathering input from various stakeholders, including 1. Providers of financial information, to understand the effort and expense involved in collecting and reporting the information. 2. Users of financial information, to gauge the value and utility of the information in decision-making. 3. Auditors and academics, to provide insights into the accuracy, reliability, and implications of the information. The assessment typically combines both quantitative and qualitative data. Quantitative assessments might include numerical cost estimates and potential economic impacts, while qualitative assessments might consider the overall usefulness and reliability of the information. Example: feedback loop. Providers. Companies might report that the cost of implementing a new reporting requirement is high due to the need for advanced data collection systems. Users. Investors might indicate that the additional information significantly enhances their ability to assess the company's future prospects and risks. Board's decision. Based on this feedback, the board might decide that the long-term benefits to investors and the market justify the initial costs to companies. Subjectivity and variability. Given the inherent subjectivity in evaluating costs and benefits, different stakeholders might have varying opinions on the same reporting requirement. To address this, the board considers the broader context of financial reporting, not just the impact on individual entities. This ensures a balanced approach that considers the needs of various users and the practical realities faced by providers. Example: differing assessments. Large public companies might find it easier to absorb the costs of new reporting requirements due to their extensive resources and sophisticated financial systems. Small private companies might find the same requirements disproportionately burdensome due to limited resources and simpler financial operations. Board's approach. The board might introduce scaled requirements where smaller entities have different, perhaps simplified reporting standards compared to larger entities, ensuring relevance and feasibility across the spectrum. Conclusion. Understanding the cost constraint on useful financial reporting helps us appreciate the balance required in financial reporting standards. It's about ensuring that the information provided is not only useful, but also economically justifiable. Chapter 2, Summary: Qualitative Characteristics of Useful Financial Information. In Chapter 2, we covered the following key points. 1. Qualitative characteristics of useful financial information. Fundamental qualitative characteristics. Relevance. Information must be capable of making a difference in user decisions, possessing predictive or confirmatory value. Faithful representation. Information must accurately depict the economic phenomena it represents, being complete, neutral, and free from error. 2. Enhancing qualitative characteristics. Comparability. Enables users to identify and understand similarities and differences between items. Verifiability. Assures users that information faithfully represents the phenomena it purports to represent through direct or indirect verification. Timeliness. Information must be available in time to influence decisions. Understandability. Information must be presented clearly and concisely, making it comprehensible to users with reasonable knowledge. 3. The cost constraint on useful financial reporting. recognizes that providing financial information incurs costs which must be justified by the benefits, involves assessing whether the benefits of information outweigh the costs, considering input from various stakeholders, balances the needs of different users and providers, ensuring practical and useful financial reporting. Thank you for watching. If you found this helpful, please subscribe to our channel and like the video to support us. See you in Chapter 3.